Welcome back to the second video in our series entitled The History of Cost Segregation. So let's start off by really just defining what is cost segregation. Well, basically it's an IRS defined and sanctioned approach using the combination of construction engineering and tax expertise, which allows commercial property owners to reduce federal taxes by accelerating depreciation on their properties by separating real or essential versus personal and non-essential components of the building and reclassifying the depreciation on the personal items from 39 years to either 5, 7, or 15 years. Basically, this results in accelerated depreciation, reducible taxable income, and of course, increased operating cash flow. Now let's just look at it from a graphical point of view, what the effect of cost segregation can actually have on your business. It's really about taking a bigger slice today versus waiting for it. And because of that, when you take into account the time value of money, whether you're putting it back into your property or you're putting into other investments or other income earning vehicles, the bottom line is having a bigger chunk of your money now through tax benefits is it can be for many people the best strategy. So the history of cost segregation. Here's a high-level timeline. Let's start with the early days. The very first version of cost segregation came through the investment tax credit, which was a component-based analysis type of process. And then in 1986, that really was ended, and really large companies with deep pockets were really only in position to take advantage of that type of strategy. But, in 1999, the Hospital Corporation of America decided to stand up against the IRS and, fight for their right to reclassify items and depreciate them quicker. And they ended up winning. And this really impacted anything from new construction, existing property, recent acquisition, renovations, green projects, 1031 exchanges, anything that occurred from 1987 to the then current time. Could take advantage. Now, 1999, the IRS actually put together a legal memorandum, 1992-1045, where they agreed that they would not contest future cost segregation studies, and also were not going to contest the Hospital Corporation of America. In 2002, they introduced the Form 3115 and updated that procedure. And basically, your accountant or cost seg advisor, firms like us, can help you put that together, that 3115. But the bottom line is it's fairly simple and can be submitted right away. You don't have to wait for any period of time to take advantage of the new accounting method and the accelerated depreciation. And in 2004, the IRS actually introduced something called the catch-up provision, which allowed companies to actually go back and make it retroactive from the time that they actually purchased the building. So anyone who's purchased the building over the last few years could certainly take advantage of accelerated depreciation going back to when they purchased the building, and that first year benefit can be significantly greater when looking at that. So basically, we understand why the deduction exists. We understand that the IRS released a memorandum saying that they would not contest future cost segregation studies in 1999 due to the landmark case that the Hospital Corporation of America won. But here's the bottom line and the caveat. And it's that IRS agents have to verify that an engineering and architectural study has been completed. And that's really where our firm comes in, and firms like ours. We put together, as I said in our first video, engineering and tax expertise to put together the study and help you produce the maximum benefits or the best strategy for your situation while taking advantage of cost segregation. The IRS has defined how companies like ours or anyone doing a cost segregation study who has the engineering and tax expertise, this is really the foundation or the basis that needs to be followed when putting together a cost seg study. So really, this is your tax break from the IRS. It's something that's almost like a right, life, liberty, and the pursuit of accelerated depreciation. It just is. It's something that all businesses, all commercial property owners should look into. We'll get into the details in future videos, but the bottom line is we can help you do that. It's very painless and quick to determine quickly the impact of a cost segregation study on your situation. Now we'll just look at some basics. The rule of thumb in terms of what you can expect in terms of reclassification. Normally 20 to 40% is average in terms of reclassifying assets in terms of total value. And so there's a lot of room to reclassify and accelerate depreciation on the overall value of your building. In our next video, we want to get into what and who qualifies, and really just make sure there's no misunderstandings or myths out there about how this works or who it can work for. Look forward to talking to you then.